Welcome everybody to the 40 Finance channel. My name's Jeff Beers, and today I've got my 6 recession-proof stock picks to help you get through what might be coming up next. As we've seen with China trade and some other stuff, the stock market has been down, and while no stock is recession-proof, there are some sectors that you can hang out in as opposed to taking all your money out of the market and moving over to bonds and savings accounts, which right now with today's interest rates, not really a good place to be because they're just not paying any money. So I think these 6 stocks can still show some successful growth even in an economic downturn. Let's jump in and see which ones they are. All right, first on the list today is Visa. And Visa, the reason that I like them, and it's not because of interest rates for credit card abusers, so to speak. Visa is actually almost like a gateway or a toll for all credit card payments that use the Visa brand. So basically they're a transaction game, right? They get fees associated per transaction, and now that we're entering the digital age with where more and more people are using their cards and they're looking for credit card rewards and all these sort of like micro transactions that happen on the web, Visa's in a really good spot. Think about them as a toll operator, and the sheer fact that you have more cars coming down the road into the toll booth just means more money for them. And as Visa expands their presence and works with more and more gateways to handle payments, and the consumer shifts more and more towards using cards for payments, it's just a great situation regardless of an economic downturn. I would see in an economic downturn you might have average order values go down, but in this digital climate right now, payments themselves to cards and through cards are actually going up. Now Visa right today has a share price of $178. They have a P ratio of 34.22 and a forward PE of 28.47. And you can see on the chart here, they did go down with the stock market dip in December, but it's been an upward trajectory ever since. As a bonus, you get a 0.57% dividend yield, which is great. Now let's take a look how they fared in our last economic downturn. Okay, I have this chart for all 6 stocks on our show today, and it basically runs from 2006 to 2016, so a 10-year period. And the goal here is to take a look at where a stock stood prior to the 2009 stock market bottom, and then again watch how the stock has grown since the bottom in 2009 up through 2016. In Visa's case, it's kind of interesting because they didn't IPO. Visa did not IPO until 2008. As a matter of fact, there was a lot of swirl about their IPO because it came out at the exact same time as some of the economic collapse. And despite that fact, they had a successful launch. And even when stocks hit their bottom in 2009, Visa maintained a percentage over the S&P 500. And ever since then, as the market turned around, they have been increasing their growth substantially over the S&P 500. And while this gap has widened considerably, if you would have got in 2009, it just goes to show you how much padding you would have had, so to speak, even in this upcoming potential recession. You're so far ahead with Visa on this gap that even a downturn, assuming you're not going to take your money out for another 10 years, you're riding in pretty good shape. But overall, I think Visa is relatively immune to some of the recession fears only because they're based on transaction volume. And the shift in consumer behavior with digital and e-commerce, I think that they're in a place where transaction volume is only going to grow. All right, next on our list today is Walmart. And I like Walmart in an economic downturn, not only because of their pricing model that saves people money and they offer a lot of low-cost alternatives to expensive things, But from a brick and mortar standpoint, Walmart is the one who's still winning in this time of Amazon, right? Probably them and Target and a handful of others like Home Depot and such. Those are really the places that you could count on to continue to do well, even during a recession, because people still need their basic needs, right? And Walmart obviously sells groceries, goods, sporting equipment, outdoor stuff. There's a basic cost of living that I think Walmart encompasses, and even during a recession, they're going to be able to make strong sales. Stock right now sits at $112.99. You have a PE ratio of 25, forward PE drops to 22.15, and they do have a 1.88% dividend yield, which is a great bonus. Okay, looking at Walmart's 10 years from 06 to 16, you can see in the 09 collapse, Walmart stood still. They were actually pretty much flat, outperforming the S&P all the way through 2012. Then they went up with the market. They did have a scare back in 2015 and 2016 as the intersection of e-commerce and Amazon started to spook investors on what would happen to Walmart. But they've since recovered after 2016, and their most recent earnings report showed a huge growth in digital and e-commerce. I think Walmart's fine. People still want a brick and mortar presence even as we go ahead in the future. And Walmart's model of low prices is 9 times out of 10 going to be the first choice for America as a whole. There's a lot of jokes about Walmart stores and their quality, etc. But the bottom line is, when you need to save money and you need to pick up some of the essentials for your family, Walmart is definitely an option. Okay, next up on the board is Google. And Google might come in and raise some eyebrows with some of you because from a recession-proof standpoint, you might be quick to point out that they rely heavily on advertising revenue, which would likely get cut by some companies going into a recession. And while I do agree with you that that is somewhat true, I would say that digital and video advertising are going to be the last things to get cut in that scenario. I think what you would see more likely is sponsorships, television ads, mailers, stuff like that that's pretty cost intensive. Digital advertising, if anything, you know, there's always going to be people advertising, right? And Google's going to have the most accessible inventory, particularly with YouTube. So I like them even during a recession. Stock right now sits at $1,177. It's had some ups and downs this year with privacy concerns. But if you look at Facebook and how they got out, you know, sort of weathered the storm on privacy and paid their, you know, $5 billion fine or whatever it was they recently doled out, that's the same, you know, that's like the worst case scenario for Google. They might have to pay out billions of dollars in fines. Quite frankly, it's a blip on the radar for a company that's printing money like they are right now. So I'm less concerned about that. If you look at it from a PE standpoint, you got a PE of 23 right now, which is great for a digital stock like this. Forward PE drops to 21.11, and no dividend for this particular one. And you're going to have a little bit more volatility because it's still considered a growth stock. But I think all the signs are there that they could succeed even in a recession environment. All right, so looking at the 10-year 2006 to 2016 for Google, you can see that running into the 2009 collapse, they did go down just with the market. There was still a nice separation on performance for Google over the S&P 500. And ever since then, coming out of that low point, just like some of the others featured today, the separation and performance for Google has been outstanding. Most recently, in the last 4 or 5 years, it's been big gains. I wouldn't be surprised if Google does have a dividend sometime in the next, call it 2 to 3 years, as things start to slow down in America. So in my opinion, it's a great stock to own. They also have exposure to some of the other upcoming technologies like autonomous vehicles. They're also in with Waymo and Lyft and artificial intelligence. So those are going to be growing industries even during the recession that may or may not be coming up shortly. So think about Google as a recession-proof stock. All right, next on the list during a recession, you're going to want to look to McDonald's. Absolutely, for sure, McDonald's will be able to maintain through a recession with their low-cost menu. People are still going to eat. The population's growing. McDonald's has a lot of great plays, and they've been performing as a stock year after year after year. And while I would definitely be hesitant to be in some of the consumer discretionary like Darden restaurants and some of the higher ticket restaurants, McDonald's is one that I think could even gain more of consumers' money because folks are going to be looking for low-cost alternatives when they don't want to cook for themselves. Stock price right now, guys, it's at $218.47. You got a PE ratio of 28.69. Forward PE drops to 24.97. And as a bonus, like some of the others, we get a 2.2% dividend yield to give you that extra change as you're going through an economic tightening cycle. A lot of positive signs here for McDonald's. Okay, on the 10-year chart from 06 to 16, you can see very similar to Walmart, McDonald's, it's like the 2009 stock market dip never even happened for them. They're showing some great separation coming out of the gate here in 2006 from the S&P 500. You see the dip in 09 really didn't affect them at all. Slow and steady growth all the way through this 10-year cycle. I don't see any reason it won't continue. McDonald's, even when they've fallen before, when they kind of released breakfast and it was sort of in and out, there's a lot of controversy on some menu items that they had that they weren't going to be able to perform correctly. McDonald's fixes problems. They fix profits. They own a ton of real estate. You really can't go wrong at any time of year investing in them. All right, next up we have one of my personal holdings, TJX Company, aka TJ Maxx. And TJ Maxx obviously will always have a great opportunity during a recession because they're selling quality clothes, brand name accessories for discounted margin. And frankly, in this digital age, it seems like no one is really paying full price anymore. Even now with low unemployment and decent wage growth, folks are still looking for a deal. They're going to TJX in droves, and it's really starting to pay off. Now, if it's a China-based trade war that comes upon, you could see some higher prices for TJX to fulfill their inventory. But two things to think about there. One is those prices are going to be passed right along to the consumer. And secondarily, you are going to see the products that people want. So let's just take Polo, for example. I buy some Polo golf shirts at TJ Maxx. That shirt, while it may go up slightly in price, say from $25 to $28, you're going to see the same Polo shirt at a full brand retailer go up as well. So the discount is still going to be relative in modern terms. And that's why I think TJX doesn't have a whole lot to worry about with China tariffs. They also tend to buy most of their product on the second market. So if Macy's, for example, cleans out a ton of inventory, TJX isn't importing from China, right? They're just buying from Macy's and bringing it over. So their price might change, but I don't see it as a huge risk right now. Share price right now at $51.39. You got a PE ratio of 21.05 and a forward PE of 18.03. They do pay a dividend of 1.83%, which is very helpful, particularly in this retail market. Now let's take a look how they fared over the last recession. All right, so the 10-year chart here, and once again, they pretty much ran neck and neck with the S&P 500 from 06 all the way through when the market started to go down in 2009 towards its bottom. They bounced quickly off the bottom, and ever since then, the separation in gains from the S&P 500 has been pretty substantial. So not a huge line in the sand here, right? So you actually have to get up pretty close and know the background story of 2009 to look at TJX and say, well, you know, how did they do, or when was the time that they went down in 09? It's not a big dip in all actuality. So it makes me feel pretty good looking forward. TJX, I think, is one retailer to look at absolutely for sure during a recession time. All right, last up on the recession stocks, OReilly Automotive. And I could have plugged and played a lot of automotive names here. You have AutoZone, which is like a $1,500 stock. There's Advanced Auto Parts, and there's another one that's not ringing a bell with me right now. But O'Reilly has really been a strong growth stock in the auto parts business. They don't pay a dividend right now, but they've really jumped in to a competitive segment and made a lot of headway. And when you think about recessions and you think about people having to scale back on their budget items, number one, it's hard to scale back on car repairs because if your car's not working, it's not going to do you a lot of good. So I think the market for auto parts stays about the same regardless of, you know, what time of year it is. And you could also see quite an influx in sort of DIY car repair, right? Folks that don't want to pay $400 or $500 to get a brake job at the mechanic are going to be a lot more in tune to, say, watching YouTube, learn how to change their own brakes, buy them from O'Reilly or someone just like them. And so you could actually see an increase in store sales for O'Reilly, especially when you think about another factor, and that is, will people be as interested in shopping for a new car if there's an economic downturn, or will they be more likely to invest in a few repairs on their existing car? I definitely think it's the latter, and O'Reilly's in a good spot. You got a stock price right now of $381.64. You got a PE ratio of 22.76. Forward PE goes down to 19.48. And again, they've really come in and been a strong growth story in a market that's pretty competitive. Let's see how they did during the last economic downturn. All right, 10-year chart once again, looking back from 06 to 09 when the market went down to its bottom. O'Reilly was kind of chugging along at that point. Now, they were a different, younger company back then, and most of their growth stories happened in the past 5 to 7 years. But you can see that there is separation. They did separate from the S&P 500 despite the 09 dip, and they continue to grow that separation from 09 all the way up to today. It's been a pretty substantial upward trajectory. And I think going forward, this could be one of those stocks that even during a recession continues to grow, right? They're not paying out dividends. They're reinvesting in the company. They're attacking the auto parts market. And there might be an opportunity for them during a recession to change up marketing, maybe change their pricing model a little bit and steal some market share from a big company like AutoZone. And if that happens, you're looking at a segment that would actually produce solid returns for you even during a recession. All right, guys, so those are my 6 recession-proof stocks. As a disclaimer, there's no stock that's really recession-proof. However, if you just think a little bit about everybody's business model before you jump into stock buying during an economic tightening, you kind of have to just think to yourself, well, does the recession affect this company, right? So if it's like, I'm just going to say Disney World, I would be sort of hesitant. I would figure that park travel and attraction and ticket prices are going to weigh pretty heavily on tourists. If there's a true recession, I would say Disney would struggle in that world. Same thing with airlines, hotels, automotive brands like Ford and Chevy. People, again, they're probably going to keep their car. So that's really what this list is me looking ahead, looking for strong companies, thinking about, will these strong companies be able to survive when everyone's budgets get a little tighter? I feel good about these 6. And in the world of low interest rates on savings accounts and bonds and things like that, I'd be inclined to stick it out with these 6 companies and just give myself a chance to add to my position and get ready for the next bull run. Hope you guys enjoyed this. Please like and share with your friends. I appreciate your support. We'll see you on the next video.